My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money, and welcome to a special San Francisco edition of Cramer. Other people make friends. I'm just trying to make a little money. My job is not just entertainment, but educate teachers, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. We love coming out here. We love coming out to California to find out what we're missing back in New York. Every time we do it, I make a point of speaking to at least 20 CEOs. Some of that is because I'm completely crazy. Because it's my job, though, to explain to you what's happening. So first, I need to know what's happening myself. It's discipline, and it's rigor. And it's always better to be informed than to be ignorant. Because in this business, information, not ignorance, is bliss. I know it's going to be hard for some of my Twitter followers, but bear with me. At the conclusion of 4 brutal days that coincided with Salesforce's Dreamforce Festival, the Dow sinking 107 points, the S&P losing 0.84%, and the stupid NASDAQ tumbling another 1.37%. What have we learned here? All right, let me go over my findings and put them in the context of events away from tech. First, I made a point of asking everyone, I mean everyone, whether they were having any trouble attracting talent to work at their enterprises. I got a very unified answer. Absolutely not. I mean, like, just plain no. Unlike last year, where there was brutal competition for workers, now they can find people easily, both in sales and in software development. And by the way, in service, if you're talking even about a restaurant. This kind of shocked me because last year, coming out of the pandemic, good salespeople were incredibly hard to find, and unemployed computer scientists were practically an endangered species. Now, the whole dynamic has reversed out here, and there is genuine fear of joblessness. Some people I spoke to at a Red Hot Chili Peppers concert, see, I remember that name, weren't just worried about their jobs. They were actually worried about their companies. I was worried that I didn't know the lyrics. Others wanted my help finding work. Man, it's late when you're asking me for help finding work. Anyway, what a difference less than a year makes. Now, this morning on Squawk on the Street, David and Carl asked me if I was concerned that Fed Chief Jay Powell doesn't know all of this, and he might press too hard against a severely weakened economy. I said, absolutely not. I don't want anyone to lose their job. But I know the Fed needs to stamp out inflation, especially wage inflation. And at least out here in Silicon Valley, that process is playing out exactly how Powell wants it. What's bizarre is that if we do go into a recession, the epicenter will be here in San Francisco, where so many new companies have been created, creating too much demand for labor, demand that's now vanishing rapidly. Second, there's an overriding sense of indispensability of these products, or at least claimed indispensability, a belief in the necessity of their own technology. Almost everyone has a story of why their product will have to be bought by customers, because the clients will have no choice if they don't want to be left behind versus their competition. I want to give these guys the benefit of the doubt, but in almost every single case, I believe the indispensability thesis is exaggerated. For example, it is better to be in the cloud than in old-fashioned on-premises systems. Everybody knows that, right? But no, you're not going to go out of business if you don't make the switch. As for the companies that help get you on the cloud or make it better, I think their clients could easily defer making that move, maybe even by a year, maybe 2, because there's a real cost to migrating now. For a company I helped found, it cost $2 million to make the switch to the cloud from on-prem, which wrecked the quarter, and the analysts didn't understand the necessity, and the stock almost got cut in half. It seems indispensable until, well, it isn't, because business is so bad. Sure, I saw companies making chips for self-driving cars, and we know that's the future. But what happens if it's a distant future, not something near term? It can be deferred. Anything that's in test mode simply won't make you a lot of money. It's a deadweight loss. It could cost you a lot of money. And few companies want to spend that kind of cash in a bad economy. They're frozen. Some companies are still tainted from COVID. They had businesses that over-earned during the depths of the pandemic, like the gaming companies, which peaked as the world went back to normal. This was hard to tell at the time because we didn't realize how quickly our country would morph from a goods and services economy to a mostly service with far fewer goods economy because we wanted to go places. This is what I call the 9 wedding thesis. They got 9 weddings to go to that were deferred. So the pendulum has gone from solid growth in gaming to an actual retreat in gaming, which has been very tough on chip makers like AMD and NVIDIA. At the same time, though, genuine indispensability doesn't seem to matter. Skyworks Solutions came here. They make chips that are essential to cell phones. Marvell is essential to high-performance computing and 5G. Yeah, nobody cares. Now, how about that? How do we explain that? Because their stocks trade in lockstep with the semiconductor sector, thanks in large part to the proliferation of these sector-based ETFs that the brokers love so much. You can have great news from an individual company, like we're seeing from Marvell, and I know it is great news, or from Skyworks, and you know what it means? Nothing. These fantastic growth stocks sell at ever-shrinking price-earnings multiples because they're the best houses in bad neighborhoods, and no one cares about anything other than the neighborhood. The same goes for many of the cloud companies. Some of them are doing just fine, but they'll never get the credit they deserve in this environment because the whole group has gone out of style. I also learned this week that if there's any true indispensability out there, it comes from the abundant talent pool located here. I managed to pull off, it was kind of a great honor, with Mark Tessier-Levine. He's the president of Stanford. And we chatted about what makes the best of the best go out here to Stanford. A big change versus when I was coming out of high school. He talked about the fun of learning, the great experience, the joy of the campus. I know sometimes people think that's par for the course in higher ed these days, but we never heard any of this stuff when I went to Harvard in the 70s. When we went to the new research hub of Johnson & Johnson earlier this week, it was quite evident there's a ton of tremendous talent coming out of both Stanford and UCSF, as well as other schools. It's an insanely good research institution at UCSF. I love it. Nothing the Fed can do, nothing can change that, thank heavens. Hey, speaking of the Fed, here's another lesson. As much as Jay Powell can impact all these companies negatively, and he can, the best ones have the ability to reinvent themselves on the fly. Salesforce.com, the host of Dreamforce, is probably the best example. For the longest time, Salesforce grew, often aided by expensive acquisitions that ultimately did pay off. Yesterday, though, co-CEO Brett Taylor told me that the focus was profitable growth and returning capital to shareholders. Holy cow! The company raised its growth forecast, reiterated its target of $50 billion in revenue by fiscal year 2026, despite now having an additional $2 billion in foreign exchange headwinds, and also committed to returning 30 to 40% of the company's bountiful free cash flow. So the $10 billion buyback that the company announced in August, its first ever, might be the first of many such programs. What a change! If you've been selling the stock of Salesforce, it tells me, hey, maybe you want to rethink what could be an ill-advised strategy. Look, we are in a tough moment. I have not denied that from day one. As I've said multiple times, although almost no one seems to believe me, the Fed wants the price of all assets down, including your homes and your portfolios. Jay Powell can only do that by making it more expensive to borrow money. That's exactly what he's doing. Bottom line, while some of these tech companies have business lines that may be somewhat immunized against higher borrowing costs, they are few and far between out here, regardless of what people might say about their own indispensability. Terrific companies, great products, but not as much immunity from the hardship as many of these CEOs seem to think. All right, let's take calls. Let's go to Jackson in Illinois. Jackson.
Hi, Jim. Thanks for taking my call.
Of course.
With heightened geopolitical tensions, what is your outlook on Raytheon Technologies?
I'm going to see you and raise you one better. I think Raytheon and Lockheed are both fantastic. These are these stories right now because we can't make enough weapons, and we need to give the weapons to other countries. So this is one of the few bull markets out there. I always end the show by saying there's always a bull market somewhere. It's in defense. Eric in Tennessee. Eric.
Hey, Jim. Thanks for taking my call.
Oh, thank you, Eric.
My question is in regard to Dick's Sporting Goods, ticker DKS. I currently own shares of this company and have really liked the management and fundamentals of the stock for some time. The stock has been in an upward trend since June 16th of this year.
Right.
Looking at the 3-year chart, it looks like the stock might be even setting up for the last leg of a reverse head and shoulders pattern, which tends to be bullish.
And I see that too. And Eric, I've got to tell you, I think the main thing that I know, Lauren Hobart, that was maybe one of the 3 or 4 best research calls that we've had in retail this year. That last quarter was monster good. I applaud you for finding that stock, and I want you to stick with it at 9 times earnings. All right. While some of these tech companies have business lines that might be somewhat immunized against higher borrowing costs in a slowing economy, they are few and far between, even though they hope that's not the case. Well, Mad Money tonight. After Salesforce completed its acquisition of Slack last year, where does the company stand in its integration? I'm checking in with Slack's co-founder and CEO. Then inflation remains high. But what could history tell us about what's on the horizon? It is shocking. and we're going off the charts to find out. And Splunk stock has been a funk of late, like many others. So have investors spotted an opportunity, or do they need to steer clear for now? I'm talking to the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.